Stock Market versus Economy, Episode 1. The stock market has little to do with the real economy. The stock market is supposed to reflect the broader economy. In theory, both should rise and fall together based on productivity, employment, wages, and consumer confidence. But over the past few decades, that relationship has broken down. Wall Street has surged during periods of high unemployment, stagnant wages, and uneven recoveries, while reacting sharply to political announcements, court decisions, or global trade disruptions, often with little connection to everyday economic reality. These contradictions raise an important question. Why has the stock market become detached from the real economy? The answer lies in structural changes to modern capitalism, shaped by monetary policy, globalization, and inequality. Do y'all remember when gas prices only went up once a week? Thursdays? The nature of the stock market. The stock market exists to help companies raise capital and allow investors to buy and sell ownership stakes. It provides liquidity and opportunities for wealth creation. But it is not a direct measure of economic well-being. The market reflects the profitability and expected future earnings of publicly traded corporations, not the lived conditions of workers or households. Many of America's largest companies earn a substantial share of their revenue overseas. Meta earns over 60% of its revenue abroad, Apple more than half, Intel nearly 80%, and Coca-Cola around 65%. In many cases, a large portion of their workforce is also based outside the US. This alone weakens the link between stock prices and domestic economic conditions. Market concentration and distortion. The US stock market is dominated by a small group of massive corporations: Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, ExxonMobil, Walmart, and Tesla. These firms now account for more than one-third of the S&P 500's total value. The top 10 stocks alone represent nearly 40% of the index, compared to about 14% a decade ago. Because these companies are global giants, their performance depends more on international markets than on the US economy. Heavy concentration in technology also masks weakness in other critical sectors like manufacturing, healthcare, and consumer goods, creating a misleading impression of economic strength. Monetary policy and cheap capital. Since the 2008 financial crisis, central banks, especially the Federal Reserve, have played a major role in sustaining markets. Policies like quantitative easing inject liquidity and suppress interest rates, making borrowing cheap and pushing investors towards stocks. Corporations use this cheap capital for stock buybacks and mergers rather than job creation or wage growth. These moves boost share prices without increasing real economic output, reinforcing the gap between market performance and worker prosperity. Globalization and financialization. Globalization has further weakened domestic ties. Companies like Chevron, Johnson & Johnson, Alphabet, ExxonMobil, and Procter & Gamble earn large portions of revenue abroad, insulating their stock prices from local downturns. As a result, corporate success no longer guarantees economic stability for American workers. At the same time, the economy has become increasingly financialized. Companies prioritize shareholder value through buybacks, accounting strategies, and cost-cutting. When layoffs occur, stock prices often rise, rewarding investors while harming workers. Profits concentrate upward, not outward. Speculation and investor psychology. Markets are forward-looking, driven by expectations rather than current realities. Stocks can rise during recessions if investors anticipate recovery or government intervention. Today's markets are also shaped by retail investors, social media, and trading apps, making investing faster and more emotional. Fear of missing out fuels speculative behavior and meme stocks. While participation feels empowering, it often leads to poor timing and lower returns for individuals. Conclusion. The divide between the stock market and the real economy is structural, not accidental. Rising markets increasingly reflect corporate efficiency, automation, and global reach, not wage growth or economic security. With roughly 10% of Americans owning about 90% of all stocks, market gains overwhelmingly benefit the wealthy. The modern stock market measures the success of capital, not the prosperity of citizens. It no longer mirrors national well-being. Today, the stock market tells the story of corporations, not the economy that sustains everyday life.